We have Ed Maran, MD, and co-portfolio manager of Thornburg Investments. He joins us from Santa Fe, New Mexico, and Ed manages over $4 billion at the Thornburg Value Fund. And Ed, congratulations so far, up 12% in terms of returns. So that's an outperformance in the past year. What about the markets right now? You know, people are talking about QE3. Your expectations?
You know, I don't know what the odds are of QE3, but I do believe that if we get QE3, that the Japanese central bank and the European central bank are going to have to join in with significant monetary easing or quantitative easing of their own. Right now, the yen is near record strong against the dollar. They can't stand much more strength, and the Eurozone obviously can't afford to have its companies become less competitive given everything that's going on there. And I think that a concerted effort by all of those three central banks would be a very powerful stimulus for the equity market if it does happen.
Well, all eyes right now on the U.S. economy as well. That's why we have this talk of QE3, because it seems like every sector of the economy is slowing down in the U.S. Services, as we see disappointing services numbers overnight, manufacturing contracting almost at its lowest in 2 years, and then you have GDP anemic in the first quarter. What's going on? Are we going to see a double dip?
I don't think we're going to see a double dip. I think a lot of the problem is that banks are being far too restrictive in their lending. That has a lot to do with government oversight, concern about capital standards, and as the banks build capital, I think that they're going to start loosening up and that we're going to start seeing loan growth that will help drive the economy. And on the positive side, companies on the S&P 500 have shown an ability to generate strong profit growth even while the U.S. GDP has been rather slow growing.
It has been a blowout earnings season, you're right, Ed, but that was put on the back burner, of course, with all the theatrics we saw in Washington over this debt debate. Some are saying with the slowdown that we're seeing in the U.S. economy, you also want to cut spending at this point. This could be a huge mistake for the U.S. economy. Your thoughts?
Yeah, I think that tightening fiscal policy right now would be a classic error. It reminds one of what happened in 1929. The only thing we need to add to it is to start having trade barriers go up at the same time, and then we'll have we'll have everything we need. But I think that
Ed,
cooler heads will
let's
prevail.
talk about safe havens first. Yeah, well, let's hope cooler heads prevail. But what about safe havens right now? Take a look at the rally we saw for technology shares overnight. It seems like technology was the standout sector in the earnings season. Is it still good to get into, or have you missed the gains already?
I absolutely think the valuations are compelling for these technology companies. Because of their global franchises, they benefit if you have a weakening U.S. dollar. They typically have no debt and lots of cash on the balance sheet. If you have to weather a storm, I would much rather be in a Microsoft at 9 to 10 times earnings or a Google at 13, 14 times earnings instead of having U.S. dollars earning 0%. So I think that technology is a safe haven. I think that that's a good way to look at it.
All right, Ed, thanks for sharing your thoughts today. Ed Maran, who's the co-portfolio manager and MD at Thornburg Investment Management from Santa Fe, New Mexico.